Welcome students, myself Professor Vikrant Palatcha. Welcome you all in my YouTube channel Professor Vikrant Palatcha's Education Hub. Dear students, in this today's video lecture, we are going to study how to calculate the income from house property. So let's begin. So first of all, we are going to understand what is income from house property is there. So the income arising out of house property either in the form of a rental income or on its transfer is referred to as or is called as the income from house property. So whenever the assessee is getting any income from the house property in the rental form, or whenever that assessee is transferring that house property and due to that the income is generated for the assessee, that income is called as the income from house property. Okay. In essence, any property such as house, building, office, warehouse is treated as house property under the Income Tax Act Section 2020. So Income Tax Act Section 2022 defines any kind of house, any kind of building, any kind of office or warehouse that is categorized as a house property as per the Income Tax Act 1961. So to treat the income as an income from house property, these three conditions should be satisfied. At that time, the income arising from the house property will be treated as income from house property as per the Income Tax Act 1961. In that, the first condition is that the property should consist of any building or land apportioned thereto. Okay. So means the property, it must be in the form of building or in the form of land. At that time, the income arising from that property is called as the income from house property. Okay. Then condition number second is what? The assessee should be owner of the property. The particular property that is under the ownership of the assessee. This condition is also necessary to be satisfied. Then last condition is there. Condition number 3 is there. The property should not be used by the owner for the purpose of any business or profession carried on by him, the profits of which are chargeable to income tax. So whenever the assessee has a house property, assessee is the owner of the property. But suppose that property used by the assessee to carry out his own business or profession, at that time the income arising from that house property will not be considered as income from house property. That will be chargeable under the income from business and profession. So whenever these three conditions are satisfied by the assessee, and the assessee is getting the income from the house property, that income will be termed as the income from house property. Okay. So it is the meaning of the income from house property. Then there are several income. Those are arising from the house property. But such incomes are not treated under the house property as a taxable income. These are always considered exempted or tax-free as an income from house property. In that first one, income from sale for residential house. So the house that is assessee own for the self resident means self residence purpose, at that time any income arise from that house property is totally exempted under the head. Okay. The next one, income from official residence of former rulers. So before the independence, there were several rulers were there. Suppose those rulers has their own palaces or their official residences, and if they are getting any income from that, that is also treated as exempted or fully tax-free under the house property. Income of some social and charitable institutions. Several social organizations are there, several charitable institutions are there. Suppose if these charitable institutions like Mandir, then any kind of social organizations are there, if they are getting the income from their house property, it is always exempted as income from house property. Okay. And finally, last one is what? Income from agricultural farmhouse. We know agricultural farmhouse, that is utilized for the agricultural operations. And if any income getting by the assessee from that, that will be totally exempted. So these are the several incomes. Those are exempted income from house property. Okay. The next, there are three types of house properties are there. Self-occupied house property, number one. Then number two, let out house property. And number three, partly let out house property, that is also called as a deemed to be let out house property. So in that self-occupied house property, the property which is utilized by the assessee for the owner residence, that house property is called as a self-occupied house property. And as I told, any income arised from the self-occupied house property, that is totally exempted under the head of income from house property. Okay. The next one is what? Let out house property, the property which is rented by the assessee, which is given on the rent by the assessee, that property is called as a let out house property. Okay. And last one, partly let out house property. So this is the property in which some part is given on rent by the assessee, and some part utilized by the assessee for own residence or for own business and profession. That kind of house property is called as the partly let out house property or the deemed to be let out house property. So in this property, some of the portion which is rented and remaining portion utilized by the assessee for the owner residence or for the owner business and profession, that kind of house property is called as a partly let out house property. Okay. So these are the three types of house properties are there. Now we are beginning, that is the most important point of this video. What is that? Computation of income from house property. So while computing the income from house property, these four concepts are very important. Okay. In these four concepts, first of all, municipal value, then fair rent, then standard rent and actual rent. Very important concepts are there. So in that, municipal value means what? For collection of municipal taxes, local authorities make periodic survey of all buildings in their jurisdiction. And they are determining the value of all these properties, and this value determined by the municipal corporation with their periodic survey related to the particular house of properties. That value of the property is called as the municipal value. So this is the value, municipal value, who determined by the municipal corporation of that area for collection of the municipal taxes. Okay, property taxes. This value of the property is called as a municipal value. The next, fair rent. It is the reasonable expected rent which the property can fetch. It can be determined on the basis of rent fetched by similar property in the same or similar locality. So in the area the property is located, so according to that, the another property, those are located in the same area. From the observation of those property, when the rent amount of property is determined, that property, that amount is called as the fair rent. Okay, that is the second. The next one, number third, is what? Standard rent. It is the maximum rent which a person can legally recover from his tenant under the Rent Control Act. Standard rent is applicable only in case of properties covered under the Rent Control Act. So the rent determined according to the Rent Control Act that the assessee will get from the tenant, that rent is called as the standard rent. Okay. And last one, number four, actual rent. It is the amount actually received by the owner of the house property. The amount which is actually received by the owner, means assessee, from the tenant, that amount of rent is called as the actual rent. Okay. So these are the four concepts. These are very important while we are going to solve the problem related to the house property. Okay, understood, dear students? So these are the four concepts. Now, most important, how to calculate income from house property. Now, dear students, in the coming slides, we are going to discuss the steps. These steps are necessary to calculate the income from house property. So one by one, in detail, we'll discuss the time. Before discussing the step, we are going to discuss the format in which we have to compute the income from house property. So dear to student, this is the format. In this format, we have to calculate the income from house property. So first of all, we have to determine the gross annual value of the property. So dear student, this format we are going to discuss. First of all, we will discuss it for the income from let out house property, and then I will explain you how to compute the income from the self-occupied house property. Okay, so this is, we are going to discuss the how to calculate income from house property, and that is a let out house property. So in that, first of all, what we have to determine? We have to determine the gross annual value, that is GAV. Okay. Once the gross annual value determined, at that time, we have to deduct the municipal taxes paid. The taxes which are paid. Which taxes? Municipal taxes. Those are deducted from the gross annual value. And in regarding this, one condition is also there. Suppose these taxes were unpaid during the previous year, or it was paid by the tenant. What I am telling you, suppose if these municipal taxes were unpaid or were paid by the tenant, at that time these taxes won't be deducted from the gross annual value. Understood? When these taxes won't be deducted from the gross annual value, when these were unpaid during the previous year, or these taxes were paid by the tenant, at that time it won't be deducted from the income from, it won't be deducted from the gross annual value. If these taxes are fully paid by the assessee in the previous year, then these will be deducted. Clear? Understood? After deducting municipal taxes from the gross annual value, the next amount we get, that amount is called as what? Net annual value. Okay? So after deducting these municipal taxes from the gross annual value, the next amount we'll get, this amount is what? Net annual. Okay? Then from the net annual value, we have to deduct the deductions under section 24. Two deductions are there. After getting the NAV, means net annual value, we have to deduct the deductions under section 24. Two deductions are there. First deduction is the standard deduction. That is always 30% of net annual value. Two deductions are there. And in that, what is the first one? That is the standard deduction. And how much it is? It is always 30% of the net annual value. And second one is what? Interest on borrowed capital, or interest on capital that is taken by the way of loan, or that is the interest on loan. So for the construction of the property, whatever the loan taken by the assessee, on which the interest paid by the assessee, that will be deducted as second deductions from the net annual value. And after deducting these two deductions as per the section 24, the last amount we'll get, and that is our final answer, and it is income from house property. Okay? So in this way, this is the format in which we are going to calculate the income from house property. Now one by one, we're going to understand the steps, and then we'll discuss how to solve the problems there. Okay? So in that, step number one, what is that? Calculation. First of all, we are going to calculate what? Gross annual value. Okay? We have discussed this format. In this format, the gross annual value, first of all, we have to calculate. So to get the gross annual value, what we have to do? So under that, we have to calculate a reasonable expected rent. We are going to calculating what? Gross annual value. And to find out the gross annual value, what we are going to discuss there? Reasonable expected rent we have to calculate. So reasonable expected rent will be higher of the following. What? RER. Reasonable expected rent is RER. And this amount how to calculate? So reasonable expected rent will be higher of the following. Number one, maximum of municipal value and fair rent. The amount between the municipal value and fair rent, which one is higher? Means you have to compare the municipal value and the fair rent and find out the highest of that. And then minimum of maximum value of above and standard rate. Once you got the higher from the municipal value and fair rent, you have to compare it with what? Standard rate. Okay? And the amount which one is minimum. What I am telling, the amount which one is minimum from these two. That is standard rate and maximum of the municipal value and fair rent. That amount be reasonable expected rent. Understood, student? How to get a reasonable expected rent? For that, first of all, you have to compare the municipal value and fair rent and find out the maximum of that. Once you get the maximum of that, then you have to compare it with the standard rate and find out the minimum of the both, means standard rate and maximum of the municipal value and fair rate. Which amount is minimum, which amount is lower from these two, that will be your reasonable expected rate. Understood? So under the gross value calculation, first of all, we have to find out the reasonable expected rent. For that, we have compared the municipal value and fair rent. We have find out the maximum of that, and then we have compared it with the standard rate and the amount which is minimum from the standard rate and maximum of the municipal value and fair rate. That is our reasonable expected rate. Once we get the reasonable expected rent, then we have to find out the actual rent. What we have to find out? Actual rent. Actual rent means what? The rent for which the property is let out during the previous year. Okay, actual rent is the rate which is for which the property is let out during the previous year by the assessee. So while computing the actual rent, one amount is also important there. So while computing actual rent pertaining to vacancy period is not to be deducted. However, unrealized rent is to be deducted from actual rent. So while calculating the actual rent, two amounts are most important. One is the annual rent. Means annual rent means what? We have discussed during the definition. Annual rent is the rent which is received by the assessee during the previous year regarding the property. Okay, for the property, the actual amount received by the assessee during the previous year, that is called as the annual rent. And many a times, the tenant is not paying some rent to the assessee. Okay, during the previous year, the amount of rent which is not paid by the tenant to the assessee, that amount is called as the unrealized rent. So these two concepts are important. One is what? Annual rent, the amount which is actually received by the assessee, and the unrealized rent which is not received by the assessee from the tenant. These amounts are important. So under the step number 2, for getting the gross annual value, what we are going to calculate? We are going to calculate the actual rent. And actual rent is equal to annual rent minus unrealized rent. So suppose unrealized rent is given in the problem, then you have to deduct it from the annual rent. And suppose if it is not given in the problem, unrealized rent is not given in the problem, at that time your annual rent will be actual rent. So how to compute the actual rent? Actual rent is equal to annual rent minus unrealized rent. If the unrealized rent given in the problem, then you have to deduct it from the annual rent. If it is not given in the problem, so there is no need to deduct it. Clear? Understood? So therefore in the step number 2, what we get here? Actual rent. Now under the step number 3, you have to compute the gross annual value. So gross annual value, it will be higher of the reasonable expected rent and actual rate. The highest value from the reasonable expected rate and actual rate minus loss due to vacancy will be your gross annual value. So what is now loss due to vacancy? So loss due to vacancy means what? Suppose if the property remains vacant during the previous year for a particular period, that period is called as the loss due to vacancy. Okay, when the property remains vacant for the particular period during the previous year is called as the loss due to vacancy. Okay, and that loss due to vacancy we have to deduct while computing the gross annual value if it is given in the problem. If it is not given in the problem, then there is no need to deduct it. Okay, if it is given in the problem, then calculate it and deduct it from the gross annual value. And how to calculate the loss due to vacancy? Very simple. Annual rent divided by 12 into vacancy period. Annual rent, that amount is already in your problem. Divided by 12 means what? 12 months of the year multiplied by the vacancy period. Vacancy period is also mentioned in the problem. With the help of that, calculate the loss due to vacancy, and while computing the gross annual value, deduct it. So how to calculate the gross annual value? Under the step number 1, we determine the reasonable expected rent, and in the step number 2, we have determined the actual rent. Compare both amount. Which amount? Reasonable expected rent and actual rent. And the amount whichever is higher from these two, that will be gross annual value subject to loss due to vacancy. If loss due to vacancy is given there, then deduct this loss due to vacancy amount from the highest of the RER and actual rate, and then the amount you will get, that amount will be your gross annual value. Understood, dear student? So first of all, here we got what? Gross annual value. Once you get the gross annual value, at that time you have to deduct there the municipal taxes. What? You have to deduct there the municipal taxes from the gross annual value. Okay, as we discussed in the format. See, this is the format. Once we get the gross annual value, then from the gross annual value, what you have to do? You have to deduct the municipal taxes from it. And once you deduct the municipal taxes from it, the amount you get, that amount is called as what? Net annual value. Understood? So gross annual value, once you get, from that you have to deduct the municipal taxes paid. And the amount you got from that amount is called as the net annual value. Understood up to here? Any doubt, any difficulty? Okay. So net annual value once you get, then from that net annual value, you have to deduct the deductions under section 24. Two deductions are there. Okay. Now, which these two deductions are there, in detail we are going to discuss. So, under section 24, the first deduction is what? That is a standard deduction. What? Standard deduction. That is the 30% of net annual value. Always, this is the fixed amount. And this is always the 30% of net annual value. The net annual value you got, of that net annual value, 30% amount you have to calculate, and that is the standard deduction, and you have to deduct it from the NAV. Then second deduction, important one, that is most important. What is that? Interest on borrowed capital, means interest on the loan taken. In case of the let out house property, very clear and simple rule is there. In case of let out and partly let out house property, maximum deduction will be 2 lakhs. How much is the maximum deduction? Let out house property 2 lakhs. If the amount exceeds 2 lakhs, then assessee will get only 2 lakhs as a deduction. If any amount below 2 lakhs, whole amount will be deductible as an interest on loan or borrowed capital. So therefore, in case of the let out house property or the partly let out house property, how much deduction you have to deduct? That is the interest on loan under section 24 for, and how much is the maximum limit? 2 lakhs is the maximum in case of let out house property or the partly let out house property. Understood? Now most important, what? In case of self-occupied house property, minimum deduction will be 30,000 and maximum deduction will be 2 lakhs. How much is the minimum amount? We are going to discuss how to compute the income from self-occupied house property in next slide. But here, in relation to the deductions under section 24, remember, whenever any loan is taken for the self-occupied house property, at that time, whatever the interest paid on that loan, there is a condition, minimum amount of that interest will be deducted 30,000 and maximum will be 2 lakhs. So suppose if a loan is taken after 1st April 1999, then maximum deductible amount will be 2 lakhs, otherwise it will be 30,000. If the loan is taken for repairs or renewal of the house property, then in each case, maximum deductible amount will be 30,000. So suppose if loan is taken after 1st April 1999 and construction is completed within 2 years of the self-occupied house property, at that time the maximum amount will be 2 lakhs, and if it is not completed, means construction is not completed within 2 years, at that time the deduction available is only rupees 30,000. Clear? Understood? Loan should be taken by the assessee after 1st April 1999 and construction of the property will be completed within 2 years. At that time, maximum amount of the interest assessee will get as deduction of rupees 2 lakhs. And if the construction is not completed within 2 years, at that time assessee will only get rupees 30,000 in relation to what? Self-occupied house property. And suppose if the loan is taken by the assessee for the renewal or for the repair of the self-occupied house property, then the deduction amount is only rupees 30,000. Clear? Understood? So therefore, in relation to the self-occupied house property, interest on loan will be deductible maximum 2 lakhs or minimum 30,000. In case of let out house property and partly let out house property, rule is very clear. The maximum amount will be 2 lakhs. There is no such condition. Condition is only there in relation to the self-occupied house property, maximum 2 lakhs, minimum 30,000. Okay, so these are the deductions under section 20. Now, how to calculate the income for the self-occupied house property? Very simple. Remember what I am going to tell. So, whenever the self-occupied house property is given in the problem, at that time, up to net annual value, everything will be nil. Clearly understand what I am going to tell you. Whenever you are going to compute the income from self-occupied house property up to net annual value, each and every amount is zero. Each and every amount is nil. Your gross annual value is zero. Your net annual value is zero. Everything is nil up to net annual value. And from this nil amount, from this zero amount, you have to deduct the deductions under section 24. Your net annual value nil. Then under section 24 deduction, standard deduction is also nil. And whatever the loan interest amount is paid, that you have to deduct from the zero, right? From the nil amount. Therefore, you will get the negative figure from the self-occupied house property, and that is called as the loss from house property. You will get the negative figure there because you are deducting the deduction from zero. Okay? Therefore, always there is a loss from house property in case of the house self-occupied house property. Okay? So, while computing the income from self-occupied house property up to net annual value, every amount is zero, right? Every amount is zero. Every amount is nil. Therefore, self-occupied house property, there is always loss because you are getting the minus figure there. Okay? And then from the nil net annual value, zero net annual value, we are going to deduct the two deductions. That is the standard deduction 30% of NAV. NAV of the self-occupied house property is nil, zero. Therefore, standard deduction is also zero. And the second one, that is what? Interest on loan, that may be 2 lakhs or maybe 30,000 maximum or minimum. So you are deducting it from zero. So suppose if it is 2 lakhs, then 0 minus 2 lakhs minus 2 lakhs. If it is 30,000, then 0 minus 30,000 minus 30,000. So minus figure is there. So therefore, from the self-occupied house property, there is always a loss. Okay, understood? In this way, you have to compute the self-occupied house property. So dear student, in relation to the income from house property, this is the theoretical aspects we discuss. What we discuss in this video, we discuss what is income from house property, meaning then exempted income from house property, three types of house property we discuss, then the municipal value, fair rent, standard rent, actual rent, its meaning we discuss. Then we have discussed the format of the income from house property. Then we discuss the several steps. Accordingly, we have to compute the income from house property. Okay, so this is all the theory. I hope you understood all these theoretical points very well, because to solve the problem, these theory, if you understood, then only you can able to solve the problem. So in the coming videos, we will solve some problems related to the income from house property. I hope all the information I have explained you understood very well. So just wait for my next video. In that I will explain you how to solve the problem related to the income from house property. I request you all kindly subscribe my YouTube channel for such more educational video, as well as like this video and share with your friends. Thank you all of you.